Tell us a little bit about how the bond market has been performing as we head closer to the end of the financial year. One would assume that liquidity is starting to dry up and appetite is quite low.
Eleni, good afternoon. It seems we are all in a celebration mood. I will start by telling you happy birthday this afternoon. Eleni, I want you to be abreast that about 60% of the fixed income market or bond market is being controlled by deposit money banks. Now we have less than 2 weeks to close our financial year ends. Activity hasn't really been on a very high side. But I will start by saying that what we have noticed is that there have been a sort of little increase in the higher duration bonds. The reason is because some of the PFAs are trying to sell down. But there has been a very cautious attitude by the majority of the dealers because we are guiding against taking some positions that may actually result in some mark-to-market either gain or loss because of the IFRS that everybody is going to face in the few days to come.
Humphrey, thank you very much for the wish. I really appreciate it. And I do hope that when you do come to South Africa, you'll buy me a chocolate cake. Let's also touch on the inflation index, Humphrey. It remained unchanged in November. What is your view with regards to the CBN tightening monetary policy sooner? Do you think that it's going to happen once again, or do you think that the brakes are now in place?
Eleni, inflation being maintained at 10.5 with all the preemptive strike that the CBN has used within the last 3 or 4 months ago. You know that we are at 12% presently, which is almost double of where we started this year. What you have to realize is that I've taken time to look at the analysis of what made up the inflation index figure. It seems that the domestic goods prices has to a very large extent succeeded in bringing down the inflation index. That has actually resulted to what I've said several times in this program, that we need to look at what's actually creating, putting on pressure on inflation. It seems we need to look at the secondary level of the economy. The risk sector of the economy is down. So government needs to channel their efforts there. Because if we continue using this issue of making use of interest rate, which is one of the strongest tools you can make use of in controlling inflation, there's tendency we may play down that the real growth we need in the economy.
Humphreys, with regards to the economic environment at this point in time, we're starting to see the growth potential of Nigeria growing quite significantly. What is your sense with regards to the overall economic policy going forward? And as you alluded to, the fact that the growth potential needs to, of course, be the major focus going into next year, it seems that there needs to be a very fine balance that must be struck.
Yes, balance is the right word to use. That's why I say that if you're actually making use of tools like increasing interest rate, yes, there's tendency you may attract growth from other parts of it by bringing something like foreign direct investment. But the issue is that what type of investment do you need this time around? If you are increasing interest rates and some other tightening measures that will make use to be attractive to foreigners and you are bringing them in here, most of these investments are portfolio investment. They're highly volatile. They may not really contribute so much to the capital formation. All we need is to look at some other indices that could attract, because if you are a foreigner and trying to make an investment decision, it may not really be returns. The environment where you operate, talking about, for example, talking about the issue of power sector, if you are here and your cost of production is so high, that's tendency, high yield may not be your major reason for bringing your investment into it. So by and large, what I'm trying to argue, or the argument I'm advancing, is that presently, the Apex Bank need to align most of their policy with what the executives are planning in terms of their spending this year. We are looking at a situation where infrastructure development may be high, but at the same time, we need to prioritize it and put it a part of those things as a priority that will actually bring a manufacturing sector to a stable condition.
With regards to the type of foreign direct investment that we could actually see coming into Nigeria, where do you think that we'll actually see the most appetite emanating from?
Talking about the type of foreign direct investment that this country needs at this stage of development, you look at that from 1960 to date, we've been operating a sort of primary sector of the economy, talking about the extractive industry. We don't need to engage ourselves in a lot of analysis to understand that it has not really impacted the way we actually need, which shows that there's need for us to advance to the secondary level of economy as I've been preaching. So if we look at what we are doing presently, the manufacturing sector remains the only thing that can create the necessary investment we need, which will precipitate into creating employment. And that's the only way the national output will increase, which will actually reflect positively in the growth you need in any economy. And as I said earlier, putting a lot of effort in advancing or increasing yield may not take us anywhere. It can only result of investment that will be highly volatile, which can leave us anytime. And for a developing economy like Nigeria, we may need, and I repeat, to a large extent, suffer inflation to a very little extent. But in the near future, it will be solved.